This liquidity framework completely changed how I invest and use cash as an asset in my portfolio. In this video, I'll be explaining three things. 1. The hidden power of cash and how it can boost your long-term returns. 2. How the liquidity framework works in practice, including a real-world example. And 3. How to determine the right level of cash for you and incorporate it within your own portfolio. First, let's cover the hidden power of cash. I recently read The Psychology of Money by Morgan Housel, which was an excellent book that all investors should read. Though it was chapters 5 and 10 that laid out the key insights that could completely change how you view cash in the context of investing. Specifically, it illustrated the hidden value of cash to provide one the confidence to hold long-term, even in the face of fear and volatility, and 2, provide flexibility over one's time and opportunities, which includes personal, career, and investment opportunities. Now, this generally seems pretty obvious. Having cash allows you to do more things and have more flexibility, but it wasn't until reading these chapters did I really make the link between how cash impacts the investments in your portfolio. Put another way, greater cash balances, what's normally called an emergency fund, allow you to have less emotional reaction to volatility and also put your personal finances in a stronger position to handle that risk. These factors combine to give you the confidence to hold your investments and even buy more when others are panic selling in fear or desperation. This gives you an incredible long-term edge as an investor, as you have the ability to let your investments compound long-term. I know compounding is almost always talked about in investing, but not always is the most important rule talked about when it comes to compounding, and that is to never interrupt it early. If you let compounding work, you can see incredible wealth-building results. This is an elegant graphic I found that demonstrates this concept, and for many people, it's cash that gives you the power to take the path on the right. Warren Buffett is a living example of the miracle of compounding. In 1962, as Buffett was starting his investing partnership, he had a net worth of $450,000. Fast forward to 2024, Buffett's net worth passed over $130 billion, and he built his wealth famously with no net leverage and conservatively, always having ample cash. Many have cited that it was this prudence that allowed him to outlast all of his peers and allow some of his greatest investments to compound for decades. A lot of the time, the focus of cash, at least when it comes to investment, is on the seen factors. If your cash is in a bank account, it might be earning nothing in interest. If you're savvy with your cash, you might have it in a money market account. But either way, the interest or lack thereof is the seen return from cash. What is also seen and frequently discussed is the opportunity cost of holding cash compared to the next best alternative. Historically, this comparison has been made to returns in the S&P 500 stock index. If the market is up 20% and you're holding extra cash, this is something you'll definitely see, and in some cases you can feel it too. However, there are unseen returns of cash, which in many cases are just as valuable, if not more valuable than the seen returns. Having the confidence to not sell, hold, and buy more in the face of fear and panic can provide extraordinary financial returns on the cash that you've set aside. Additionally, the flexibility over opportunities puts you in a position of strength and control over the direction of your life. And the second thing we'll discuss is how the liquidity framework works in practice. And for this, I think the best way to showcase this is with a real-world example. So in this case, we have a tale of two brothers, Brother A and Brother B. Now these brothers are similar. They're both financially successful and have the same financial goal. They want the highest long-term investing returns. Each are currently making $100,000 per year in income and have expenses of $72,000 per year. So each year they're saving 28% of their income, or $28,000 per year, that goes towards investments. Now remember, both brothers want the highest long-term investing returns. However, the one area where they're different is how they're planning to approach this. Brother A has the mindset and philosophy that he'll invest all of his extra cash so it can generate the highest return. Brother B is a little bit more conservative, so his thinking is that he'll position himself to have the best chance of uninterrupted growth. Neither of these mindsets are necessarily wrong, and both have their light in the sun. But as we'll see, these perform a bit differently when things don't go as favorably. Now here's their initial assets and setup. Both of them have initially $100,000 in assets. Brother A holds $18,000 in cash in an emergency fund. Brother B is much more conservative in this sense, holding $72,000 in cash in their emergency fund. They both love Apple products, so they decided to invest their entire remaining assets in Apple stock. Maybe not advisable in terms of diversification purposes, but that's what these two decide to do here. So in this case, Brother A is keeping 3 months of expenses in liquid cash, which puts him at the limited liquidity level. Brother B is holding 12 months of expenses in liquid cash, which puts him at the secure liquidity level. Now, unfortunately for these two brothers, we do have to put them through one of the worst stress tests possible, which is the financial crisis and market crash of 2008-2009. Unfortunately, both brothers, Brother A and Brother B, lose their job in August of 2008, and unfortunately, they'll be out of work for 8 months. Brother A will pay all of his expenses from cash, and when he runs out, he'll then sell his Apple stock as he needs to fund his expenses. Brother B, on the other hand, will pay all of his expenses from his larger cash emergency fund. Initially, prior to losing their jobs, both brothers were able to accumulate about an additional 2,500 shares of Apple in those first 7 months of 2008. Now, these are stock split adjusted share counts, so that's why they look a little high compared to today's numbers. However, at the beginning of August, when they get their layoff announcement, Brother A has almost double the number of shares as Brother B. For those next 3 months, both of the brothers are living off the cash in their emergency funds, so neither of them is forced to sell any shares of Apple. However, unfortunately, after those first 3 months, Brother A's emergency fund runs out, and he's forced to gradually liquidate or sell a portion of his Apple stock each month to cover his expenses. This graph shows the cash balance for each brother over that entire time period. As you can see, Brother B's cash balance was much higher, and while it did decline a significant amount, Brother B was not forced to sell any of his Apple shares. Unfortunately for Brother A, with his lower cash balance, he ran out of cash relatively quickly and was forced to start selling Apple stock, unfortunately at depressed prices. This is a comparison of the total net worth by brothers of the time period. As we mentioned, they both started with $100,000, but the paths they took over this time period were quite different. Brother A's net worth saw much more volatility compared to Brother B's. This is due to the fact that he had a smaller allocation of cash, so more of his portfolio was subjected to the volatility of the markets. And Brother A didn't even begin selling until roughly day 211, where he ended up selling at prices lower than where he bought. Another key takeaway from this graph is look at the max drawdown from Brother A and Brother B. For Brother A, they saw a drawdown from $100,000 all the way down to under $20,000 at the trough or lowest point. That means their wealth declined by 80% in that period. Compared to Brother B, they saw a drawdown of only roughly 50%, still a significant loss, but much less than the 80% drawdown. So here's how the two brothers stand about 1.5 years later. Brother A now has $26,800 in assets, $4,800 from what he was building back up in his emergency fund after it went to zero, and $22,000 remaining in Apple stock. Brother B, on the other hand, was able to weather the circumstances fairly well, ending up with $58,400 in ending assets, $23,000 in their emergency fund, about 4 months of expenses, and $35,400 in Apple stock. Now, for those of you who are shedding a tear for Brother A, don't worry too much, because if you look at the long-term view, Brother A still turned out okay. You see, after getting their jobs back, Brother A and Brother B both decided to refill their emergency fund first before investing any more. However, because Brother A only had 3 months to refill, he was able to start reinvesting back into Apple stock much sooner. Because of this, he was actually able to accumulate more shares of Apple than Brother B, who eventually did restart buying back Apple stock just a bit later. In this case, you can see the different cash balances of each of the brothers. With a higher cash balance, you have more cushion, but it does take more time to refill that back to the previous level. Somewhat surprisingly, even after very different starts, both brothers end up with similar net worths after 15 years. Brother A now has $3.46 million in assets compared to Brother B with $3.31 million. Now, I could have ended this example here at 1.5 years, and that would have really hammered home the value of the hidden power of cash. However, after showing you the full 15 years, it really looks like brother A was not that impacted by having a lower cash amount. So it seems like, at least initially, I've somewhat disproved the value of the liquidity framework and having more cash. However, there are a few assumptions we have to make about brother A that make him possible to end with a higher net worth in this scenario. Going back to the net worth by brothers chart, we have to assume that during this entire time, brother A did not sell a single share of Apple that he didn't need to in order to cover expenses. In other words, he would have needed to see and stomach his net worth dropping by 80% and still have the stomach not to panic sell the remaining shares of Apple that he had in order to come out on top. In addition to that, he would need to have extreme confidence in Apple stock or whatever investment he would be making afterwards to very promptly start reinvesting back into that investment. After just experiencing an 80% decimation in net worth, this is easier said than done for most people. Additionally, having Apple as the investment of choice supercharges the returns, as Apple is one of the best performing stocks over this period. Looking back, probably a better example to do this with is simply an S&P 500 index fund, in which case the net worth of brother A likely would be less than brother B, just given to the lower returns from that investment. So basically, you'd have to assume brother A has rock solid steel conviction, is able to stomach an 80% drawdown and then immediately buy back in stock when he can, and have the confidence that that investment will overcome the significant loss and drawdown that he had over the long term. And even after all of that, they still end up at pretty similar net worths. But remember, there are two hidden powers of cash. Brother B demonstrated the confidence and the financial ability to hold his investments long term. But the other value is to provide flexibility over opportunities. And that's where brother C comes in. You see, brother C was exactly like brother B, who had a larger cash emergency fund. But the difference with brother C is that instead of rebuilding his cash emergency fund right away, as brother B, he realized that because of his significant savings initially, he still had 3 months of cash, which could very well serve as a smaller emergency fund, because right now he saw a big opportunity in buying Apple stock. So notice the share count of brother C in the chart. Because of the large emergency fund like brother B, he's able to decide and take advantage of the opportunity to buy Apple stock when it's cheap. Over time, when Apple stock isn't as cheap, he slows down his purchases a little bit to rebuild back his emergency fund as well. Overall, he ends up with a much higher share count than either brother A or brother B. Here's what the cash balance looks like by the brothers. Notice brothers B and C both start off at that higher cash and go back down, but while brother B decides to immediately build back his cash cushion back up, brother C is delaying that and instead rapidly purchasing shares of cheap Apple stock. Notice later on, brother C does fill back up his emergency fund back to the full year of expenses, but he has the time and flexibility to do so when he sees fit. And this is really the true hidden power of having cash in the context of investing. You can combine those two benefits, both the confidence and financial ability to hold, as well as the flexibility of taking advantage of opportunities. Somewhat counterintuitively, holding more cash can actually lead to better investment outcomes. In this case, brother C, who had the confidence to hold and also the ability to take advantage of those opportunities, ended up ahead of brother A in all respects. His total assets of nearly 4.2 million include more Apple stock and a larger emergency fund than brother A. Not to mention, it was likely a much less emotionally stressful time during the period he didn't have a job compared to brother A, who was having to sell his depreciating shares of Apple stock. In the end, they all turned out okay, so don't worry about the brothers too much. But I hope this illustrates how the liquidity framework works in practice and how it can be used to boost and enhance long-term returns. And finally, the third thing I want to achieve in this video is to determine how to find the right level of cash for you and to incorporate it within your own portfolio. So in this case, we'll be shifting our thinking from an emergency fund, that typical 3 to 6 months of expenses that has been drilled down to us by all the financial media, and moving to more of a robust liquidity framework when thinking about our cash balances. The next question is, what level is best for us? Now, the first level is the emergency level, and that's basically when you do not have a month of expenses in liquid cash. And this is aptly named the emergency level because it effectively is a financial emergency. At this level, you don't even have 1 month of expenses saved in cash and are at risk of not being able to pay bills, food, or other necessary expenses. This is a problem that needs to be solved with urgency, so at an emergency liquidity level, you really shouldn't have any investments at this point, and if you do, you should sell those to get at least to the minimum liquidity level. Now, at the minimum liquidity level, you have at least 1 month of expenses, but this is not a lot. In general, you should never go below this level, as if you do, you're at the risk of potentially taking on debt to pay monthly expenses. This level might be appropriate for someone who has, let's say, high interest debt that they're trying to pay off, in which case it may actually make sense to not hold excess cash, as that should be used to pay down that high interest debt as soon as possible. For most people, the limited liquidity level is probably the most common. At this level, you have a bit more breathing room in case some unusual expenses come up, or you have a temporary job loss. You're able to have at least some buffer that gives you some time to get any issues resolved. In most cases, this is fine for many people, but in those rarer cases, like let's say the financial crisis, there is a chance that these reserves could be depleted. The sufficient liquidity level is twice that of the limited, which is 6 months of expenses in liquid cash, and this gives you an even bigger buffer. This is the upper range of the standard advice that starts to allow you to operate from a position of financial strength. The fifth level is the secure liquidity level at 12 months or a full year of cash and expenses. Now, for most people, this likely goes beyond an emergency fund, and which is why we're not thinking necessarily of this as an emergency fund, but it's a liquidity framework. This is liquid cash that serves the role of an emergency fund, but also provides the flexibility for other opportunities as well. We saw this in the past with Brother C, who started at the secure level after losing their job, then dropped down to the limited level after using their cash while unemployed, but after finding a new job, they decided to take advantage and use new income to purchase depressed shares of Apple stock. This is one of the advantages that can come with having a higher level of cash. The sixth level is what I call the robust liquidity level, and that's 2 years of expenses in liquid cash. Now, who exactly decides that this level is right for them? This generally could be investors who are a little more risk averse, but still want to try and maximize long-term returns. Having a higher level of cash can allow them to be more aggressive in the remaining portion of their portfolio while still having the comfort and lower stress levels due to having a very robust cash reserve. The final and seventh level is exceptional liquidity, and that is when you have 3 or more years of expenses in liquid cash. This liquidity level can provide exceptional flexibility when it comes to opportunities, both in your personal life, career, and investments as well. You won't ever be caught not having enough cash when an exceptional opportunity arises in the marketplace. Additionally, at this level, you have almost no stress or worries about any short-term liquidity needs, even if there is some kind of emergency. While 36 months of expenses in liquid cash does seem like a lot, if you're someone with relatively low monthly expenses, this might end up being an actually relatively reasonable sum. So that's just one thing to keep in mind when you're thinking about potentially moving to the more secure, robust, and exceptional levels. So to summarize the 4 colored sections, almost nobody should be at the emergency and minimum levels. If you are, you want to eventually move out of them to higher levels. Most people are okay at the limited and sufficient levels. It likely provides those enough confidence to hold long term, but likely only provides some limited flexibility when it comes to taking advantage of opportunities. I think many people would potentially benefit from at least trying out the secure or robust levels. I think it's at these levels and above that you really start to see the intangible benefits start to accrue. And it's a real confidence booster knowing you can operate from a position of financial strength. And there are some people who just need to be at the exceptional level because that's where they operate best from. This level provides you the maximum confidence to hold your remaining investments, as well as the name implies, exceptional flexibility when it comes to taking advantage of opportunities. Personally, I find that I operate best at this level, but this isn't a recommendation to anybody. Ultimately, you are the one who are going to decide your level and what works best for you. Even if you end up at the standard 3 to 6 months of expenses, I think it's worthwhile for you to be exposed to the possible options when it comes to your liquidity level. This framework has been very useful for me to reposition my thinking when it comes to cash, as in my mind, it's no longer just an asset earning a meager amount of interest, but the true value comes from those intangibles, the confidence to hold and the flexibility on opportunities. I do have one quick bonus section which covers the practical do's and don'ts when it comes to your liquidity fund. As the name implies, do keep it liquid, make sure it generates a risk-free yield, and have it accessible. The don'ts are effectively the inverse of those. So you don't want to have it invested in, let's say, stocks. You want it to generate a risk-free yield, so don't put it in a checking account and let the banks pay you 0% when you could really be earning 5% or more. And don't have it be restricted. So any cash, like let's say in a retirement account or any other account that has restrictions on how you can use it, should not be counted on in terms of the pool of liquidity that you have. And do's and don'ts when it comes to where you actually keep that liquidity, do consider high yield savings accounts and also government or treasury money market funds. These accounts and funds typically provide a high risk-free yield that you'll earn without subjecting your capital to any risk of principal loss. Things I would not consider are bond funds, corporate bonds, or stocks. Now, in some rare instances, using a short-term treasury bill, ETF, could be okay for part of your reserves, but generally if you have high yield savings account or a money market fund as an option, those would be preferable. So I hope this video was valuable in explaining my liquidity framework and how you can potentially use it within your own investment portfolio. I'm curious to know though, what liquidity level were you operating at prior to this video, and are you considering any change now?